Welcome to the Deep Dive. Today we are going to dig into PepsiCo's Q3 2025 earnings.
Yep, their guidance and this big strategic shift happening, especially in the North American snack business.
We've got the reports, the transcripts. Let's jump right in.
Yeah, it's a really important one. You've got these kind of two different stories playing out.
Right.
Internationally, things look pretty solid, but back home, it's let's say a strategic challenge in their core market.
Right, so the big question is, can these cost cuts and the innovation push actually fix the U.S. snacks business?
Exactly. That's what the market wants to know.
Okay, so let's start right at the top, just like the earnings report, the headline numbers and that commitment to the outlook. So overall reported net revenue growth, it actually picked up pace in Q3, almost 3% CHAP growth.
Yeah, on the surface. But, once you strip out acquisitions and currency noise to get to the organic number, it's more moderate.
Right, the organic numbers tell the real operational story.
Total Q3 organic revenue was up only 1%, and year-to-date, they're running at about 1.5%.
Okay, so growth, but maybe not stellar growth.
It's growth, yeah. But the bit that's probably keeping analysts a little worried is the profitability side, specifically core constant currency earnings per share.
Okay, let's pause there. That's a key metric. For listeners trying to figure out what the company's really making from its operations day to day, why is core constant currency EPS the one to watch?
Well, it basically cuts through the noise, right? It takes out two main things. First, you've got the non-core items, think restructuring costs, maybe selling a plant, stuff like that.
Gotcha. One-offs.
Exactly. And second, it strips out the impact of currency swings. By holding the currency constant, you can see if selling more chips and soda is actually driving more profit.
And the news there wasn't great for Q3.
No, it was challenging. Core constant currency EPS actually dropped 2% in Q3. And year-to-date, it's down 3.5%.
Oof.
Yeah, it definitely signals that, operational efficiency is under some real pressure right now.
Okay, so that sounds like a definite headwind operationally. But then, despite that profit slip in Q3, the CEO came out and affirmed the full year 2025 forecast.
They did. They're sticking to that low single-digit organic revenue growth for the year. And importantly, they still expect core constant currency EPS to be approximately even with last year.
How do they square that circle? Profit down in Q3, but flat for the year? How does that work?
Well, a really big piece of that puzzle is actually coming from outside help, you could say. It's favorable moves in foreign exchange rates.
The FX tailwind kicking in.
Exactly. FX has been a real pain for them all year, a headwind. But suddenly the outlook there got a lot better. The negative impact they were expecting for the full year, it's now expected to be only about 0.5 percentage point negative.
Only 0.5 point. What was it before? That sounds like a big improvement.
It was expected to be 1.5 percentage points negative, so that's a full percentage point swing. It's significant.
Okay, and what does that mean in plain English for the bottom line, for the actual EPS number?
It means that the projected decline in their 2025 core USD EPS, the number investors actually see, goes from an expected 1.5% drop to now just a 0.5% drop compared to last year's $8.16.
So basically, better currency rates are kind of papering over some operational weakness and giving them breathing room.
You could see it that way. It certainly helps manage expectations and, yeah, buys management crucial time to get these turnaround plans working.
And they're still committed to returning cash to shareholders through all this.
Oh, yeah. Big time. They expect to return about $8.6 billion in cash, mostly dividends, about $7.6 billion, plus $1 billion in share buybacks.
That's a pretty solid commitment. Okay, so if the overall picture is a bit stressed, where's the strength actually coming from? What's holding up?
It's really clear. Outside the U.S., the international business is like the rock. It just delivered its 18th straight quarter of at least mid-single-digit organic revenue growth.
18. Wow.
Yeah, that kind of consistency is pretty rare in this business. It's really impressive.
And within that, it sounds like beverages globally are doing pretty well.
Yeah. Absolutely. International beverage organic revenue was up a strong 6% in Q3, and that's even with some, minor weather issues they mentioned in some summer markets.
Okay, and domestically. How's the North American beverage side, PBNA?
That held up too. PBNA delivered 2% organic revenue growth, and the momentum seems to be really around the core brands.
Like classic Pepsi?
Yeah, trademark Pepsi is actually accelerating volume and revenue growth, especially Pepsi Zero Sugar. And they seem to be getting traction with that Food Deserves Pepsi campaign. Simple, but apparently effective.
Interesting. But wasn't there also a lot of talk about functional drinks? The health-focused stuff?
Oh, definitely. Functional hydration is firing on all cylinders, as they say. Gatorade and Propel are huge drivers there.
Propel, the electrolyte water.
Yeah, Propel Zero Sugar. It's a real star performer. Get this. Its retail sales have more than doubled since 2019.
Doubled, wow.
Yeah, it just shows you where consumer money is flowing, right? High function, clear health benefits. People seem willing to pay for that.
Okay, so we've got international stability, some domestic beverage growth, especially in
Like-
functional, which brings us, I guess, to the main event, the operational pain point, the reason for all this strategic urgency, the North America food business, PFNA, that's Frito-Lay Quaker.
Yep. This is where the challenge really lies. The CEO was pretty upfront about it, called PFNA more challenged recently. And the key number is pretty sobering.
Okay.
PFNA organic volume fell by 4% in Q3.
4% volume drop
Yeah.
in Frito-Lay.
Yeah. And look, that's not just a one-off blip. They talked about a generally subdued environment for packaged food, but it also points to some internal execution things they need to fix. That kind of volume drop puts huge pressure on margins and profitability.
Yeah, a 4% volume decline in what's arguably your biggest and most profitable segment. That's a flashing red light, isn't it?
It absolutely is.
So snacks are the core challenge. What's the fix? It sounds like, as you said, 2 tracks, immediate cost surgery, and then this big innovation push.
That's exactly how they're framing it. On the execution side, it's about getting, quote, brilliant at the basics. Better service to stores, sharper pricing, just running the day-to-day better.
Standard stuff. But the surgery part sounds pretty aggressive.
Oh, it is. They've got this massive effort to reduce complexity. We're talking about SKUs, the individual products they sell.
How massive?
Well, since 2022, they'd already cut 35% of their total SKUs across the board, just trying to streamline everything.
35% is a lot.
And they're not done. They have an additional plan to cut nearly 15% more SKUs just within the PFNA snacks division during Q4.
Wow. So nearly half their products gone in just a couple of years.
It signals a real drive for efficiency, maybe even desperation. And this cost optimization, it also means people. PFNA has cut its full-time headcount by about 7% so far this year. Yeah, and they flagged more reductions coming, plus closing 2 manufacturing plants. They're really trying to shrink the cost base to match this softer demand. They're also looking at, improving in-store selling, transport efficiencies, using tech and AI, the whole playbook.
Okay, so slash costs, simplify.
Okay.
That buys time and funds the second track, the big portfolio transformation, focusing on health, functionality. And this naked thing sounds really interesting.
It's fascinating, and it's a pretty high-stakes gamble, I think. So for the big core brands like Lay's and Tostitos, they're doing what they call a core refresh, taking out all artificial colors and flavors by the end of this year. And they're also changing the packaging, talking up the farm-to-bag story.
Like cleaning up the labels on the classics.
Right. But then you have the really new stuff. Doritos and Cheetos, NKD, that stands for naked. These also have no artificial colors or flavors.
Wait a second. If you take the artificial color out of, nacho cheese Doritos,
Yeah.
isn't that bright orange color part of the whole experience? Aren't they risking decades of brand recognition?
That's the billion-dollar question, isn't it? That's exactly what this NKD strategy is testing. Can consumers disconnect the flavor they love from the color they've been conditioned to expect? If people try these naked versions, think they taste just as good and like the cleaner ingredient list, well, that could unlock huge growth down the line. It kind of redefines what a permissible snack even means.
So it's a bet on taste and ingredients over artificial appearance.
Essentially, yes. And beyond just removing artificial stuff, there's that clear push towards new benefits, specifically protein.
Right, you mentioned that earlier.
Yeah, the innovation pipeline is really targeting areas where people might pay a bit more. So you're seeing Doritos protein, Quaker protein, Muscle Milk protein drinks are part of PepsiCo now, and even a new Starbucks coffee and protein drink combo.
So chasing that functional food as meal replacement trend.
Exactly, where consumers might swap a full meal for a snack or drink that packs a punch, functionally speaking.
Okay, let's pivot a bit now to the bigger picture stuff, the outside pressures.
Yeah.
This aggressive restructuring. It feels like it has to be connected to the noise around activist investor Elliott Management.
Oh, absolutely. You can feel the increased sense of urgency, as they put it. And maybe that was even signaled by bringing in the new CFO, Steve, from Walmart.
Right, the outsider.
Yeah, the street seems to like him, sees him as a really good operator. And bringing in an outsider, it suggests maybe a real openness to doing things differently, getting more efficient.
And the CEO said the talks with Elliott have been constructive. Sounds like they're broadly aligned.
Well, they're aligned on the outcome, right? Both sides agree PepsiCo is undervalued and should trade at higher multiples. The CEO basically argues that their existing 2030 strategy already covers most of what Elliott is suggesting anyway.
But there's always a but with activists. The big sticking point is still the idea of splitting the food and beverage businesses, isn't it?
That's the historical flashpoint. And Elliott's argument is pretty stark. They point out that the North American beverage business has, and I'm quoting here, profoundly underperformed the Coca-Cola system and Keurig Dr. Pepper on growth and margins ever since PepsiCo bought their big bottlers back in, 2009, 2010.
So more than a decade of lagging behind Coke and KDP on the drinks side, according to Elliott.
That's their central critique. And it really goes back to that decision to bring bottling in-house versus the franchise model Coke uses, which is generally seen as more profitable for the parent company.
Is the CEO completely shutting down any change there?
Not entirely. He talked about being open to nuanced solutions, like maybe refranchising some bottling territories, particularly where the beverage business doesn't have huge scale. He mentioned some southern states as an example, places where maybe running their own bottling doesn't make as much sense.
Okay, so some flexibility on the edges of the bottling network.
Yep.
But the big one, splitting Frito-Lay from Pepsi drinks, he's still totally against that.
Adamantly against it. He defends the combined model really strongly on two main points. First, consumer behavior.
Okay.
He cites research showing this incredibly high correlation, like 85% to 88%, meaning almost 9 times out of 10. When someone has a snack, they also have a beverage with it.
Okay, snacks and drinks go together. Makes sense.
And because they go together, having both businesses allows for critical scale benefits. If you split them, you lose major efficiencies.
What kind of efficiencies are we talking about?
Things like warehousing, transportation. Think about trucks carrying both chips and soda, and really importantly, winning in what they call away-from-home channels. That's like colleges, hospitals, big workplaces. Being able to offer a bundled package of snacks and drinks is a huge advantage there.
So separating them would mess up the logistics and sales strategy.
Massively. He was very direct. He said splitting the two businesses is a terrible financial idea short-term, and I think long-term as well. The cost of just untangling those huge supply chains, he argues, would destroy value immediately, even if it made an activist happy for a moment.
Right, so whether you buy his defense of the structure or Elliott's critique, the urgency behind all these changes, the cost cuts, the NKD products, the ski-woo slashing it, really seems driven by the tough reality facing the U.S. consumer right now.
That's the underlying macro story, absolutely. The CEO gave a pretty blunt assessment, said middle and low-class families are, quote, very stretched.
Yeah, we hear that a lot.
And that financial stress, it leads to specific behaviors, right? People start downtrading, switching from premium brands to value or store brands, or they just have to eliminate things they see as non-essential altogether, cut back.
Did the sources mention any specific groups being impacted or specific channels?
Yeah, interestingly, they noted a specific observation about Hispanic consumers, seeing reduced mobility, maybe less income flexibility, fewer get-togethers, and these are traditionally really important consumption occasions for packaged goods.
So fewer parties, less casual snacking.
Seems like it. And that has apparently hit foot traffic noticeably in the convenience store channel, which is a really critical outlet for them.
Okay, so this focus on hitting the right price points, on permissibility, it's not just marketing speak. It's a direct response to people literally counting their pennies.
Exactly right. PepsiCo is putting its investment focus squarely on making sure consumers can find products they can actually afford, throughout the entire month, not just after payday.
And investing in those categories that still resonate even when money's tight.
Precisely. Investing in functionality because it offers a clear health benefit people might prioritize, and of course, great taste, because nobody wants to trade down on flavor if they don't have to. The whole strategy seems to be, if a consumer does decide to buy a snack or drink, it better offer undeniable value or a tangible benefit right away.
So wrapping this up, this deep dive really shows PepsiCo fighting on two fronts, doesn't it?
Yeah, it's like these two high-pressure tracks running side by side.
On one hand, you've got this urgent, maybe even painful internal work, radically fixing the North American snacks business with huge cost cuts and this big bet on innovation like NKD.
Aggressive internal surgery.
And then on the other hand, you've got this intense strategic battle defending the whole combined food and beverage model against Elliott Management's push for a breakup.
And that transformation piece we talked about, getting rid of artificial colors, launching naked snacks, that really feels like they're trying to fundamentally shift how they define value and health for the next decade. It's a big bet on transparency, isn't it?
It really is.
Yeah.
Which kind of leaves us with a provocative final thought for you listening. If PepsiCo actually pulls this off,
Yeah.
if they successfully show that great taste and good nutrition don't need artificial colors to sell, are they kind of undermining the visual conditioning that snack brands have relied on for decades?
Interesting question.
What does a permissible snack even look like in a world where maybe flavor doesn't need that bright orange disguise anymore? It's something that could genuinely change how you think next time you're in the snack aisle.